Good evening and welcome to tonight's live webinar for the ASX Investment Opportunities in Review, 22nd of February. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Investor Signals provides a broking account service which includes access to our model portfolios across the ASX 20, 50, 100 and ASX listed ETFs, as well as US S&P 100. Also access to our ASX and US high conviction portfolios. We're now running a global short portfolio, so if you're interested in specifically a short portfolio, please call me to discuss that. We also can operate an independent portfolio where we work in partnership with you to execute ideas we jointly agree on, and we obviously have access to derivatives to enhance portfolio returns or protect portfolios. So again, please don't hesitate to call me on 1300 614 002 to discuss that further. The technology that we're using tonight is the Investor Signals member area. You can subscribe to it for $1,320 for the year. We may have people joining us this evening that are on their 30-day trial. Don't hesitate to call the office if you'd like further explanations on how to navigate around the software if you have any questions around our market strategy. Up on screen there's a graph of the Nasdaq. We've looked at this as a bit of a leading indicator. Obviously we've been in a unique period of optimism, and we've seen significant PE expansion and expectations that earnings growth are going to re-accelerate past where we started from in 2018 and 2019. That seems to be being tested a little at the moment as a result of concerns about a pickup in inflation. It was always going to be difficult to forecast what the catalyst is, and it doesn't necessarily mean we're with 100% certainty at a point of resistance where we are at the moment. But right now what's causing a concern for the market is a pickup in bond yields, and the implication that really has, not necessarily for global growth, but the implication it has for assets that have been priced off zero or near zero interest rates, and in particular where you'd expect that to see come under pressure is high PE growth stocks, which we're starting to see some of the early signs of that. So when we begin tonight's webinar or analysis of the companies, we'll take a closer look at the Nasdaq before moving into the ASX 100. So to put that into context, we've looked at this in prior weeks, but just again to go back and look at the December quarter earnings which are coming through at the moment. If we deliver $40 of earnings for the December quarter, if we continue to hit that run rate each quarter throughout 2021, it gets us back to $160 of earnings per share for the S&P 500. Last time, with the US interest rates and using the 10-year bond yields as the benchmark, last time when the 10-year yield was at 2% and we're delivering $160 of earnings per share, the index was worth 3,000 points. Now it's trading at 3,900 points, so 30% higher than where it was under similar conditions. Now we're not quite there at 2% on the 10-year bond yields. The bond yields moved up from about 0.6% up to 1.3, pushing up towards 1.4 at the moment. It's obviously trending higher, but we're not back. The argument for the bulls would be, well, interest rates are still below where they are at the moment, and we're actually going to get earnings that accelerate past where we were pre-pandemic. And that's the bit that's the unknown quantity. Does 2021 earnings actually deliver a 10 to 15% growth on top of where we started from? But here's where it gets really interesting, is when we go out to 22, the market's saying we're going to get to $200 of earnings. So another $40 on top of where we started from. And you can see in 2018 we struggled to grow earnings from 18 to 2019. So still remain a little bit cautious around the level of optimism priced into markets. On that note, let's go straight into a graph of the Nasdaq, and let's zoom in and just take a closer look at what's happening here. So we've had a few periods over the last 4 or 5 months where the Nasdaq's probed below the 10-day average, and by that I mean if we have a look at these closes on this open high-low close bar. We get a couple of days below and then it jumps back above, a few days below, jumps back above, few days below, jumps back above. So is this just more of the same? Are we at a point where we're just seeing a couple of days of selling and then risk on again and the market moves higher? Well, yeah, yes, that's possible, but the change in backdrop now is that we're seeing a fundamental shift in that interest rate market that is different to what we saw during these prior periods of 2 or 3 days of selling. So watch this with a little bit more caution, and the simple strategy here is as long as the index closes below that 10-day average, you want to be having to think about how do you de-risk portfolios or at least add some short side exposure to your portfolio. Let's move straight into a graph of the table of the ASX Top 100, and I'll toggle through these stocks and I'll share with you the thoughts on our portfolio allocations and latest earnings numbers. So we get the greatest percentage gainers to the top. We arrange it in buy order, so what we're going to be doing is looking at the best performing stock under buy conditions, and we're going to move through the buys until we get a certain way through the list, and you'll see it switch from stocks that are under algorithm buys to algorithm sells. I'll draw your attention to that, and then we'll move through the ones that are under sells. Just because they're under sell conditions doesn't mean that we don't look at them from a fundamental standpoint. If the fundamentals override the technical signals, we'll still take positions in the stock, but that's only within my personal view. The actual model portfolios are fixed on hard technical rules, and the only stocks you'll find in the algorithm models, not the high conviction portfolios, but in the algorithm model portfolios will be the stocks under buy conditions, whereas the high convictions are a bit of a hybrid of my fundamental thoughts as mixed in with those technical signals. So with that, let's start at the top of the list here in TPG. TPG reports on Thursday, so it'll be interesting to have a look at what those results look like. Obviously, we've seen them merge with Vodafone, and we're looking for more clarity out of cost synergies and what the earnings growth picture looks like there for TPG. Qantas, so one of the areas of the market that's starting to pick up at the moment, and we saw this especially in today's price action, is exposure to travel. The market seems to be getting more confident that COVID cases, especially in the US, are declining, and there's an increase expectation that people will be using retained savings to begin travelling at the first opportunity. So Qantas is moving off that support level there at around 450, but a lot of optimism already priced into where it is there at the moment. Fortescue delivered a good earnings result as expected. Fortescue, BHP, Rio, we've mostly remained exposed to those names. I would suspect that we're pretty close to highs, especially if we run into a backdrop where the broader market starts to run into resistance and pull back. So expecting more of a consolidation move at this stage out of the large iron ore plays. But Fortescue we continue to like. That's one of the better performing stocks in the model. Now gold's really been under pressure, and I think it's a unique opportunity to take a look at gold. Preference is Northern Star, I think, following the merger with Saracen, given that you're getting not only exposure to local gold play, but also the cost synergies that come through from the merger. Obviously, Newcrest still looks attractive, Gold Roads, as does Evolution at around that $4 level. We didn't see anything in the production numbers that was a concern as a standout from really any of the major gold producers. So Northern Star at around this 1060, 1070, we've added that into the high conviction list, and I commented on that in today's blog, so have a think about exposure there. BlueScope Steel delivered a terrific job, as did many of the companies exposed to the building sector. We expect to see those earnings, or certainly at least the growth rate, moderate, but BlueScope well supported there at around that $16 level. A2 Milk, is this the beginning of the breakout? I don't recall reading the earnings release yet from A2 Milk. I'll revisit that tomorrow. But we're certainly starting to see now pattern where the price actions looks to be fairly strong on the other side of that moving average there. So we could be starting to get a little bit of a rally coming into the earnings results. Beach Energy support there at around 150. Sydney Airport, so again, hard to get visibility on earnings, but if you're thinking about this whole theme of a recovery in international travel as the next sort of investable theme in the market, Sydney airports could be getting down to a level where you might want to start keeping that a closer eye on that one. Alumina support there at around 160. A lot of analysts have targets still up at around $2, $2.20 there for alumina. Newcrest, so this looks to make sense to me in an environment, especially if we are seeing the Nasdaq roll over and risk off pattern occur in the market. We'd expect Newcrest, Northern Star start to perform, so I'm assuming that we're down to levels where oversold and we're looking at support there at around that $24 level and rallying higher. Star Entertainment, it is under algorithm buy signals. It has rallied higher since being alerted under those signals at around that 335, but the whole whether it's Star or Crown, still difficult to get visibility around what those VIP gaming revenues look like in the absence of international travel. I'm surprised that both of these names have held up as well as they have done. Crown obviously has this added issue of the Victorian inquiry that's now underway. And still, facing some of the fallout from the New South Wales inquiry. Star Entertainment, as I've discussed in prior weeks, I think the market's more excited short term about the property development opportunities and the added value from the Brisbane project, and obviously apartment sales from the projects in Queensland or on the Gold Coast. Goodman Group delivered terrific earnings growth, so it actually came in above market expectations. Forecast is for earnings growth to continue at around that 10 to 12%. The development pipeline's almost doubled on what it was in the same time last year. So the detractor here for Goodman's going to be higher interest rates. If rates continue to move higher, the high PE that Goodman trades on and the low dividend yield, just over 2%, it becomes harder to justify. So generally, when you've got interest rates moving high, yield-sensitive names, so infrastructure, property trusts, will tend to struggle. What I suspect happens is you may get a spike in the short term, a spike in the interest rate, but we've seen that movie play out before, where any rally in the yields, it's failed to take out the prior high. Obviously, the Federal Reserve printed extraordinary amounts of money post-COVID. The M2 money supply expanded at about 3 times the rate that it did following the GFC. So the argument there is the additional money supply will feed its way into the economy and lead to inflation. That's an experiment that the outcome's a little bit unknown, so I don't think that's a given. But we continue to watch that interest rate market. But Goodman Group, I think on balance, given the strong earnings growth, the strong development pipeline, you want to start to have a look at this if you don't own it, somewhere between that $17 support level and I think on a real risk-off move in the market, maybe down to 15.50, but I'd be surprised to see it down at those levels. JB Hi-Fi's now triggered another algorithm buy signal there at around $48. The concern for JB Hi-Fi is post-March, do consumers redirect discretionary spending that was either on home improvement appliances or home entertainment? So is JB Hi-Fi the beneficiary of that beyond March, especially if money gets redirected back towards travel and leisure activities? But for the time being, JB Hi-Fi delivered a terrific earnings result, and we now sort of have a pattern of higher highs and a higher low here, and another entry opportunity there at just below $50. Charter Hall Group, so we're seeing across the property sector and in the ETF market, the SLF, which is the Spider ASX Property Trust ETF, is now under buy conditions, and you may have seen that added into the model portfolio today. So with that being said, at an index level, we'd expect to see a lot of the participants or the constituents of that property index also under buy signals, and we're seeing that here in Charter Hall Group under buy conditions. They're at around $12. Cochlear delivered a terrific earnings result at 50 times earnings. It is looking expensive, but the outlook continues to remain positive there for Cochlear. I think what surprised the market was how quickly elective procedures have returned back to fairly normal levels in most parts of the world, and Cochlear has obviously been the beneficiary of that. So the earnings result just surprised a little bit on the upside of consensus there. Qube, we continue to like this story, but recognise that there's probably not a catalyst over the next 6 or 12 months, but on a 2 to 3 year outlook basis, it should start to deliver high single digit earnings growth, which makes it attractive. So support there at around that 275, and again sort of there at around $3. It switched from sell conditions into buy conditions there at around 250. We continue to like sort of the outlook there for Qube. Atlas now under buy conditions. Suncorp is now under buy conditions. CBA, so it's switched from sell conditions to buy conditions. I posted this on the blog today. I've created a fairly wide range here. I'm still a little bit cautious on the banking stocks at the moment, especially with that Nasdaq rolling over below the moving average. So I've created a little bit of a downside band there to continue to watch CBA. Look at this stochastic indicator as a short-term indicator, and until the black line reverses back up through the red, which will likely occur some point within that sort of let's just say $77 range to maybe $82 range. And I'll draw your attention to sort of when that occurs on the blog. Transurban, we continue to like this as a recovery play. We see this as a lower risk recovery play than some of the other infrastructure opportunities in the market. We think sort of 12 months out from now, we start to see a re-acceleration in the dividend, and over the next 2 years, maybe a return back to the original dividend payout prior to the pandemic. Link Administration, Link and Computershare. Look, again, given sort of where the Nasdaq is, I'm not getting excited about these as an opportunity in the market right at the moment, and we'll revisit those. APA Group reports tomorrow, so we can start to get to see a bit closer look at what's happening on the earnings front there, but I do feel that it's getting oversold. It's attractive dividend yield up around 5 and a bit %. So even in an interest rate environment where they're ticking up a little bit, but it's been an out of favour sector as interest rates have been rising. The hedge funds or the fund manager been selling infrastructure exposure. IDP Education trending higher. Original buy signal back here around 1380. Woolworths and Coles. Coles in particular delivered a good earnings result, 7 to 8% EPS growth, but warned on a slowdown on over the next 6 to 12 months. Woolworths corrected really during that same period as we saw the sell-off in Coles. Woolworths has just switched from sell conditions back into buy conditions, so it's been added back into our top 20 and top 50 model portfolios. So if you don't own it at the moment, have a think about it. So support there at around that $38 level, which is where the algorithm buy signals occurred. Deep sell-off sort of level, maybe back down to 37. Wouldn't see it going too much below that. Continue to like both Woolworths and Coles. Xero, so we're buyers of this now, so the correction from 160 back to 120, that's one that you want to look at adding into portfolios. Aurora, we've been buying that off that algorithm buy signal there. It's in model portfolios. Some of the trading portfolios, we've taken profit on it. Not that the growth story was particularly exciting here, but it's the evidence of a stabilization in the earnings downgrades that had been occurring, and the stock price is now also supported by the company doing a share buyback. But we'd expect sort of roughly sort of mid-single digit earnings growth there from Aurora, and attractive dividend yield. And as I said, stock price supported by share buyback. Aristocrat Leisure, expect this to really be moving sideways. Not sure we've seen their earnings date yet. If it has been, I haven't had a chance to read through it. But I'd expect sort of the current period to be a fairly tough trading environment, but maybe a fairly optimistic outlook there for Aristocrat. So when I get a chance to review that earnings, or those earnings numbers as they come through, I'll update you on the blog. Washington Sol Patterson switched to algorithm buy conditions there at around 26.50, now pushing up, traded up to 28, now pulling back to around 20, pushed up to 30, now trading around 28. Downer EDI delivered a good earnings result and a bullish outlook statement. So support there at around $5. CIMIC has really held up quite well over the last few trading sessions in a soft market. So I still prefer CIMIC over Downer, but just highlighting that Downer did deliver a very good result and a fairly bullish outlook over the next 2 to 3 years. AusNet Services should be getting closer to support as we start to get a little bit sort of oversold in this infrastructure sell-off play. Amcor delivered a good earnings result and a really good outlook, 10 to 14% EPS growth. It obviously is a heavy weighted stock in the ASX 200, and any index selling, Amcor is going to be subject to that broader selling. The Aussie dollar moving up towards 79 also is a bit of a headwind for Amcor, as it is with Brambles. So take that into consideration. But we don't see the Aussie dollar moving high as really a commodities play and part of a risk-on play globally, where currency investors have been willing to sell the US dollar and buy higher growth or higher faster growing economy markets, and in particular where there's heavy exposure to commodities, which has obviously been one of the, when you think of inflation moving higher, commodities often move higher in as part of that basket, and with US interest rates moving higher, commodities have moved higher, and therefore you've seen the Aussie dollar also move higher with it. Woodside Petroleum now under algorithm buy signal, so it had been under sell for quite some time, and now just shifting back to buy signal. So we shuffle that support line down to there, and just maybe add in another under the low there. And we'll keep an eye on the earnings results that came through were a little bit better than the market expected, but still well down on the same time last year. Woodside's going to have some challenges ahead where it needs to de-risk its balance sheet through either asset sales or a dilutive equity raising, but we don't expect oil prices to pull back too much lower. We may see them 5 or 10% below where they are at the moment, but it's still, the trajectory for oil prices is likely to be higher over the next 6 or 12 months, especially if we're in an environment where the vaccine leads to some improvement in the access to international travel and tourism in general. So Woodside Petroleum support there at around that 22.50, and that's now added into model portfolios. Cleanaway delivered really an inline result. We see this as a buy on the dip opportunity, so add this to your watch list. Any pullback there below $2.20 is a buying opportunity. Lendlease we like. The result was messy as expected, but their development pipeline is significant. So the whole the global urbanisation plan, they've been making acquisitions throughout the COVID period, picked up a cheap site in Brooklyn in the US that they'll be developing. Obviously they've got the contract I've spoken about previously with Google or Alphabet. So tough business in the current environment, but if you're willing to sort of look through it over the next sort of 12 or 24 months, we'd expect to see Lendlease as a turnaround story. ASX getting into oversold levels. I'd be surprised if we get back down and take out the lows during March. So this sort of capitulation maybe that we're going through at the moment. The negative here for ASX is that they do have rising costs and trading volumes have been relatively low. But in some ways, if we do get a risk-off period in the market, it's a high-quality business, ASX, with critical infrastructure, and continue to just average into ASX. We see it as a good investment, albeit the timing, a little hard to pick exactly where the low ends up being. So if you're trading the market, one way to think about that is if the price is below the average, you're out of the trade. If the price is above the average, you're in it, and what you're trying to do is pick that turning point where the momentum starts to break back up through that average. But I'll continue to draw your attention to that on the blog. GPT, one of these property stocks that are now under buy signals. Afterpay, it's had a terrific run since being added into the model, but it is expensive. And if you're looking for a short exposure or a way of shorting a stock, with the Nasdaq below that average, Afterpay is a consideration. Computershare, probably a little bit more downside here in Computershare, so I'll just shuffle that support down there to around that $13. So we are seeing improvement in the business operating conditions, but they still are down on the same time last year, so no evidence there of really an acceleration in earnings, or at least what we're looking for is a match to these companies that have highlighted 5 or 10 or 15% earnings growth as the names that we want to be focusing on. So Coles, this sell-off, again, if we were to see weakness in the market and a push back down to around that $15 level, that'd be terrific buying there for Coles, so keep that one on your list. REA Group looks a little expensive, up there at around, it's almost 60 times, 62 times earnings for REA Group, so a bit expensive. Next DC, I think there's some issues there on the accounting side that makes us avoid that. Resmed, I think this is an opportunity for you to add to your watch list, certainly if we were to see it back below that 24.50, but I'd be surprised if we get back down into that lower band. Stockland under algorithm buy conditions off that $4 level, now moving back down and maybe looking to retest that. Mirvac Group supported around 215. WiseTech under algorithm buy conditions moving higher. CSL coming back down and retesting that support line there of around 260. The earnings result for CSL for the first half was tremendous. The only negative is the company never upgraded their full earnings. So essentially they delivered $1.8 billion of earnings for the first 6 months, and they're saying the next 6 months the earnings will only be around $600 million, which is obviously well down on the first half. So I'd be surprised if the full year result only came in at around that 2.4 level. So I'm expecting that over the coming months we see an upgrade from management as to what the full year earnings target range looks like. So I've created that band there on a soft market, maybe back down to 240. Big buyers of CSL within that range. Domino Pizzas delivered a good result this year and continue to be a buyer of that on any future algorithm buy signals. Wesfarmers, good result. Bunnings in particular was a standout, but continue to be a buyer of Wesfarmers on the dip there and watching any future buy signals. Sonic Healthcare, we've got the range there from sort of 33 maybe in a real soft market back down to around $31, but really anywhere just below that 33.50 to say 32.50 you want to be a buyer of Sonic. Car sales we like, delivered a good result, anywhere from that $19 support up to where we are at the moment. It's the buy range for car sales. Altium not doing anything there at the moment. Fisher Paykel, so it does trade on a high PE, close to 50 times earnings, so take that into consideration as interest rates move higher. We're seeing some of these high PE names under pressure, so we may see a break below that 28.60 level in Fisher and Paykel. I'd be surprised to see it take out the $25 level, so that becomes the buy range. And again, I'll draw your attention to any shift in those short-term momentum indicators within that range via the blog. Appen Limited, we continue to see weakness there in the earnings. Oz Minerals, so terrific earnings result here, strong growth, especially in copper and nickel, pushing up to around that $22, $23 level. We'd look for a correction during the course of this year and a switch back to algorithm buy signals there. QBE, we've seen analysts upgrade their price targets on QBE following the latest earnings results, and whilst the current result wasn't that great, the expectations for a return to normal trading conditions over the next 12 to 24 months, we've now got most analysts upgrading the price anywhere from $9.50 to around that $11 range there for QBE. IGO, not doing anything there at the moment. Mineral Resources, looking for a correction lower there. Rio, still bullish, as I said, on sort of the iron ore, whether at Fortescue, BHP, Rio. When I say bullish, getting up towards resistance levels, so consolidation, but we don't see downside risk given the strength in iron ore prices at the moment. Macquarie starting to return back towards earnings growth. So on a 12-month basis, the market's now starting to forecast 10% earnings growth for Macquarie. BHP continue to like that, up against sort of what we consider close to full value though. South 32, less interested here, maybe nearing resistance. Medibank Private, we've seen that trade lower from that $3 level. Nine Entertainment, a little bit cautious there at the moment. Worley's not doing there. Some of these I'll just skip through. ALS, Challenger, cautious there on Challenger. We think that trades lower. Origin Energy could be a counter-cyclical play, so have a think about, or a counter-technical play. It is under algorithm sell signals, but a little bit oversold, and we are seeing strength through the dividend contribution from the Australia Pacific LNG project up in Gladstone. Obviously, it's continuing to have problems in the sort of more traditional retail electricity market. Reece, not doing there at the moment, up against resistance at around $70. Orica, not doing there. Bank of Queensland, still cautious on these regional banks. Oil Search, not doing there. So preference obviously Woodside at the moment and Beach over Oil Search. Treasury, not doing there. Ramsay Healthcare, under sell conditions but fairly defensive. Downside risks are limited. Looking at probably flat to mid-single digit earnings at best. Little over a 2% dividend yield. It's been a more difficult environment for them over the last, say, 6 to 12 months. But if we were to go out 2 to 3 years, we expect to see Ramsay Healthcare on higher levels than where it is at the moment. Seek, we think this within the technology sector is looking a little expensive and susceptible to a correction lower. So that's something you have to think about on the short side of the market. Vicinity's not doing there at the moment. Australian ANZ, again maybe up against resistance as the case with NAB. Crown, cautious there. Boral up against resistance. Insurance Australia under sell signals. Centre Group under sell. AGL under sell conditions. Spark under sell. Santos now under sell conditions, so again preference Woodside and Beach over Santos. Magellan's traded lower after sort of shifting to sell signals there at around 61, now trading 44, but not looking like it's getting much buying support. Tabcorp now up against resistance at around that 450. AMP traded lower after sort of the algorithm sell signal up there at around 170, so we're not doing in that. Telstra now under sell signals. Again, I'll pause on this one just because I was pretty impressed with the earnings outlook that Telstra provided for 22-23. So the numbers, I think, were around 6.8 billion for the current financial year, growing to an increased range of around 7.5 to $7.8 billion in 22-23. So certainly, and the dividend maintained. So the prospect of TowerCo, which is the actual branding of Infrastructure Co. Unlocking value, I think bids for that need to be submitted by the end of March. So, maybe within the next 3 to 4 months, we might start to learn a little more around the market valuation of TowerCo. As I've said previously, I've read analysts who have placed up to sort of $2.40 price target on that. So if that's sold off and capital's return to shareholders, that could be attractive for Telstra share owners over the next 12 months. Westpac Banking Group just up against resistance where it is at the moment. So from a pure algorithm basis, CBA comes onto our radar. And we watch that and for a pullback and a buying support to build within that range that I highlighted earlier. Bendigo, resistance there, and we've seen a strong pullback after the strong earnings result. And you just got to keep in mind globally, we've seen a lot of the banks meet their earnings expectations or deliver even above average earnings growth through add-backs of pre-provisioned loans. So if we were to see a pick-up in the bad debt cycle again later this year, some of those add-backs are not going to be a feature of the future earnings results. And you're seeing that, I think, reflected in some of the weakness now that you're seeing in sort of post the results, the trading conditions of the banks. Brambles, the only thing I can say here is that the high Aussie dollar is weighing on sentiment. Otherwise, the earnings results came in line with expectations, and the company upgraded forward guidance to around 5 to 7% earnings growth. So I'd be inclined to be a buyer of the dip on any sell-off in Brambles, especially if we saw it back down around that 950 level. Incitec under sell conditions, James Hardie under sell. But likely to switch to buy later this year. National Australia Bank under sell. So we're actually on the short side now of NAB. Horizon under sell signals. It'll be interesting just to see how the stock price behaves. It is fairly oversold where it is at the moment. We've got the sell signal there at a 411. Reliance Corporation under sell signals. Ampol delivered a messy result, but as to be expected with the impact to refinery and international travel, jet fuel sales, etc., being impacted by COVID-related matters. So I've always had a view that 30s resistance sort of back down around this $25 or $23 level is support, and we're likely to bump sideways within that range. Ansell now under sell conditions, so the earnings outlook is really flat for Ansell. Trades on a slightly stretched PE up at around 28 times current earnings, about 23, 24 times forward earnings on a low 2% dividend yield or just under 2% yield. So I really see this mainly bumping sideways, but we're now got under sell signal there in Ansell and then back to TPG. So I'll just let's just have a look at the XJO and compare that to the Nasdaq. So here's the issue that we're seeing in the Nasdaq and in the XJO. Now, over the last number of months, again, the market's only spent a few days below this average and then rallied higher. So, we're not hitting the panic button just yet, but obviously you can't get a sell-off in the market without it starting with this type of pattern. So it's the first sign of maybe something just to keep an eye on, and that is that you've got some weakness below the moving average, are rolling over, the stochastic trending lower. So we just start to think about instruments in the inverse side of the market, which could be something like B-Bus. You're starting to see that just move a little bit higher off the recent lows. SNAS, which is the short Nasdaq, starting to see that now move a little bit higher off its lows. So both of those are double exposed. So if the market goes down by 1%, they go up by 2%, whereas a the bear ETF is probably the more simpler version. In this works in an inverse way. If the XJO goes down 1%, this goes up 1%. But if you'd like to have a chat about any of these hedging instruments, please call me